Welcome to this episode of The Third Empire. In today's episode, we discuss about the government's finances as we look at the latest fiscal deficit numbers. While we talk about the fiscal deficit, we also look at a specific commodity which has an immense bearing on the government's finances, which is the global crude oil prices. Crude prices, as we all know, have been on the rise yet again. In this episode, we look at the reasons fueling this surge in the global crude prices and look at how it would impact us as in India. Now, from a financial markets perspective, we also look at SEBI's latest plan to introduce a T+0 settlement cycle, which could potentially transform the investment landscape. Additionally, we also look at the measures taken by the government to assist with energy storage infrastructure and deep dive into the Viability Gap Fund scheme proposed by the central government. You're watching Informed Investor, the Third Empire, an initiative by Research and Ranking. Let's begin. Now, government's fiscal deficit is a critical indicator that offers insights into the financial well-being and management of a nation's public finances. Now, it essentially acts as a gauge to assess how effectively a government is financing its budget and whether it is living within its financial means. Now, to put it simply, a fiscal deficit represents the disparity between a government's total spendings and its total revenues during a specific period, which is typically one fiscal year. Now, the metric quantifies how much more money a government is spending compared to what it's earning over that particular time frame. Now, recent data from the Controller General of Accounts released on the 31st of August showed that the fiscal deficit of the Indian government has widened. It increased from 4.51 lakh crores in the April to June period to 6.06 lakh crores in the April to July period. Notably, this accounts for 33.9% of the full year target of 17.87 lakh crores as the fiscal deficit. Comparatively, during the same period in the previous fiscal year, the fiscal deficit was at 20.5% of the annual target for the last financial year of FY23. Now, let's delve into the reasons behind this widening fiscal deficit. In the April to July period, the government's total receipts increased by 1.4% year on year, reaching 7.75 lakh crores. Meanwhile, the total expenditure saw a substantial rise of 22.5%, reaching 13.81 lakh crores. Capital expenditure also rose significantly to 3.17 lakh crores during this period, marking a 52% year-on-year increase and accounting for 31.7% of the full year target. Now, it's worth noting that the government has been concentrating on stimulating economic growth by prioritizing capital expenditure. Despite the widening fiscal deficit, it's essential to put this figure in context. The fiscal deficit for April to July 2023 at 33.9% of the FY24 target is still considerably lower when we compare it to the corresponding figures in the pre-pandemic era. For instance, in the first 4 months of the fiscal year in 2018 and 2019, the fiscal deficit were at 86.5% and 77.8% of the FY19 and FY20 deficit targets respectively. Now, in the Union Budget for FY24, the government has set a target to reduce the fiscal deficit to 5.9% of the GDP or the gross domestic product. Now, this represents a decline from 6.4% of the GDP as recorded in the previous financial year of FY23, which was lower than the earlier estimate of 6.71%. Now, this demonstrates the government's commitment to fiscal discipline, and that is a welcome move. Now, while we've spoken about the current fiscal deficit, let's explore the recent developments in the oil market. In July, Saudi Arabia made a significant move by reducing its daily oil production to 9 million barrels, in addition to the 1.66 million barrels that OPEC countries had already cut earlier in the year, with 500,000 of those reductions originating from Saudi Arabia alone. Now, if we fast forward to yesterday, there was another notable announcement from Saudi Arabia and Russia. Now, they've decided to extend their oil supply cuts for the entire year of 2023. When two of the world's largest oil producers make such a decision, it undoubtedly has far-reaching implications for the global oil market. Now, you might be wondering why they are reducing oil production at this point in time. Now, to understand this, let's take a closer look at the state of the global oil demand. Initially, the pandemic had a severe impact on oil demand due to its adverse effects on the global economy. However, as we entered 2022, concerns about supply disruptions arising from the Russia-Ukraine crisis began to emerge. Now, these concerns caused oil prices to soar to record highs. Nevertheless, these elevated energy prices came with consequences, including a sharp rise in inflation as well. Now, to combat inflation, central banks raised interest rates, which in turn had a dampening effect on economic growth collectively, particularly in the regions like the Euro area and the United States. Now, we've discussed before the strong connection between oil demand and economic growth. Now, with demand for oil declining, prices started to retreat from their multi-year highs. Now, to stabilize oil prices, oil-producing nations have turned to supply cuts to support prices given the weakening demand outlook. Now, these measures have indeed had an impact, resulting in a recent surge in the oil prices. In fact, the international benchmark Brent crude crossed the $90 per barrel threshold. Now, with crude oil prices rising significantly worldwide, concerns have arisen about their impact on the global economy, especially as many countries continue to grapple with high inflation. Now, the fluctuation in crude oil prices has substantial implications for countries like India as well, which heavily rely on oil imports to satisfy over 80% of their overall oil requirements. India, the world's third largest oil consumer, has faced challenges due to high inflation stemming from rising oil prices. Meanwhile, India's import of affordable Russian oil decreased to its lowest level in 7 months in August as monsoon rains suppressed demand. Now, the world's third largest oil consumer reduced imports from Russia for the third consecutive month in August. Now, it's crucial to consider this. High oil prices can strengthen the value of the US dollar against other currencies, subsequently making oil more expensive for holders of other currencies. Now, this has affected the Indian rupee as well, which recently depreciated to a 10-month low against the US dollar, falling from 83.04 to 83.18 against one US dollar. Now, we can see that there is a ripple effect of rising crude oil prices on the Indian economy. With several factors influencing oil prices, it's essential to keep a close watch on this situation as we go ahead. Now, in a groundbreaking move that is set to redefine the landscape of the Indian financial markets, the Securities and Exchange Board of India, commonly known as SEBI, has announced a paradigm shift from the traditional T+1 settlement system to a T+0 or an instantaneous settlement process by October of 2024. Now, this remarkable decision holds a new era of agility, transparency, and efficiency in India's capital markets, promising to revolutionize the way trades are settled, transforming the investment landscape and bringing in a host of benefits for the market participants. Now, earlier this year, on January 27th, SEBI had taken a substantial step by implementing the T+1 settlement cycle. Initially applicable to only 256 listed stocks, however, starting from October 2023, this expedited settlement cycle was encompassed across all types of securities, including the exchange-traded funds, which is the ETFs, or real estate investment trusts, which is REITs, infrastructure investment trusts, the sovereign gold bonds, government bonds, and corporate bonds. Now, India thus became the first major market after China to implement the impressive T+1 settlement cycle, even ahead of major markets like the US, UK, and Japan. Previously, Indian markets operated on the T+2 settlement cycle. Furthermore, SEBI chairperson Madhavi Puri Buch recently announced the regulator's intention to introduce a 1-hour trade settlement by March 2024, which is a crucial milestone on the path to achieving instantaneous settlements by October 2024. In simple terms, with a 1-hour settlement, when an investor sells a share, the proceeds will be credited to their account within an hour, and the buyer will receive the shares in their demat account within 1 hour. Madhavi Puri Buch also noted that the technology already exists to launch up to 1-hour settlement. We just have to make it happen. Achieving instantaneous settlement will require additional technological developments, potentially taking another 6 to 8 months. Why is there a need for faster settlements at all? Well, instant settlement in this context denotes a transactional process where the buying or selling of shares or the units is immediately processed and completed. Now, the rationale behind the push for faster settlement lies in the manifold benefits it offers to all market participants, particularly in the cash segment. Now, this acceleration is expected to bolster trading volumes, reduce delays in stock movement, and mitigate the risk of defaults or fraud. Presently, investors must wait for settlement to rely on the limits provided by their stockbroker to initiate further transactions. Now, for investors, faster settlement brings several advantages. It grants immediate access to funds, enhancing portfolio liquidity. Investors can capitalize on short-term trading opportunities by promptly reinvesting proceeds from sales, eliminating counterparty default risk as well. Moreover, SEBI plans to leverage artificial intelligence for detailed market oversight, potentially providing high-quality insights to every citizen of this country. Now, to conclude, SEBI has played a pivotal role in transforming India's financial landscape, fostering a more investor-friendly ecosystem while safeguarding investor interests. Now, these proposed changes mark a significant shift in India's stock market dynamics, prioritizing reduced settlement times and improved investor convenience. Over the years, SEBI has introduced numerous regulatory measures aimed at enhancing transparency, market integrity, and investor confidence. Now, as the global trends shift towards cleaner energy production, there's an increasing demand for large-scale energy storage systems for electricity grids. Now, in the month of June, the Indian government announced an ambitious plan to launch a 15,000 crore PLI or production-linked incentive scheme to promote the development and deployment of grid-level batteries. Further, there is a recent news of the government approving a 3,760 crore Viability Gap Fund aimed at bolstering the feasibility of infrastructure projects for battery energy storage systems, providing a significant boost to the renewable energy sector. Now, what exactly are grid-scale batteries, you may ask? Now, grid-scale batteries, also known as the battery energy storage systems, are designed to store renewable energy and release it during periods of high demand to maintain a stable electrical grid. Now, they play a crucial role in ensuring a consistent flow of power at a steady frequency. Now, as India pursues an ambitious agenda for a greener future, the importance of battery energy storage systems becomes increasingly evident. Now, this endeavor will necessitate substantial investments starting from the fiscal year 2027, with the total investment expected to reach an impressive 3.5 lakh crores over the next 5-year period. Now, what is the Viability Gap Fund scheme exactly? Now, the Viability Gap Fund scheme is a government initiative aimed at providing grants totaling to 3,760 crores to enhance the feasibility of infrastructure projects related to battery energy storage systems. Now, it will be particularly beneficial for the renewable energy sector during times when green power generation is limited or insufficient. Additionally, the fund will be disbursed in 5 installments, each linked to different stages of implementing battery storage projects, and these grants will be entirely funded by the central government. Now, under this scheme, the government will offer financial support equivalent to up to 40% of the capital cost of the BESS projects totaling 4,000 megawatt hours until the fiscal year 2031. Moreover, the scheme aims to reduce the levelized cost of storage to a range of 5.5 to 6.6 rupees per kilowatt hour, making energy storage a viable solution for managing peak power demand. To put this into perspective, the current LCOS is around 10 to 11 rupees per kilowatt hour. Now, this initiative will not only facilitate the integration of renewable energy into the electrical grid, but also minimize energy wastage while optimizing the utilization of transmission networks, thereby reducing the need for costly infrastructure upgrades. Now, the government has set an ambitious goal of meeting 50% of the country's energy needs from renewable or non-fossil energy sources by 2030, with a broader objective of achieving 500 gigawatts of installed renewable energy capacity. Now, the policies and investments made by the Indian government are paving the way for a sustainable and green energy revolution within the country. These efforts will not only enhance India's energy security, but also position it as a global leader in renewable energy innovation and deployment. With that, this is Raj Mehta signing off, wishing you and your loved ones the very best. Thank you.
Did you like watching this video? Then download our app, Informed Investor, to watch more such informative and interesting videos.